For exercise 15, exercise A1, we are going to, on May 1st, 2017, BJ and Paige formed a partnership. Each contributed assets with the following agreed upon valuations. So this is what they agreed upon, what the value was. Remember, we recorded at what the fair value is, what the market value is at the time. So we're going to prepare a separate journal entry to record each partner's contributions. Excuse me. So 5/1/2017, and we'll start with BJ. He contributed cash of $80,000, and he contributed equipment of $50,000, and that combines to BJ capital for $130,000. Then we're going to do Paige's journal entry. On May 1st, 2017, she contributed cash of $20,000. She contributed equipment of $60,000. She contributed a building of $240,000. Should I move this up? Let's bump this up. What did I do there? I needed more room. Sorry about that. Okay, so she contributed cash of $20,000, equipment of $60,000, a building of $240,000. She apparently had a loan on that building, so she's also contributing a loan payable, or the loan for that, of $100,000. And then her capital is going to be these three things, which is $320,000 minus the loan payable of $100,000. So here's all my assets of $320,000 minus the $100,000 I still owe on it. So her capital balance is going to be Paige capital $220,000. Then for exercise 2, we have the partnerships of Chase and Chloe shares profits and losses in a 70%, 30% ratio, or a 70-30 ratio. I like percentages better, honestly. So, respectively, after Chloe receives a $10,000 salary, prepare a schedule of how the profit and loss should be divided, assuming the profit and loss for the year is $30,000, $6,000, or a loss of $10,000. So, if they had a profit of $30,000, we are going to pay Chase $0 in salaries. He doesn't work in the business. We're going to pay Chloe $10,000. Then allocate the remaining income, or the income that's left. So the remaining income, we just paid out $10,000 of it. So now we've got, I don't even know how you necessarily write this up. We've got $30,000 in income. We just paid out $10,000 of it. So minus $10,000. So we have $20,000 left. So how are we going to allocate that remaining income? It says that we split it 70-30. So Chase is going to get 70% of that $20,000, and Chloe's going to get 30% of that $20,000. So 20,000 times 70%. He's going to get 14,000, and Chloe's going to get 30% of that 20,000. So that equals 20,000. So the total division of the income, Chase got 14,000, Chloe got 10,000 in salary, and then 6 in the remaining allocation. So she got 16,000, and the total division of income was of the 30,000 that they made. Okay, so now we're going to move to, they only made $6,000. So Chase has no income. Chloe's going to get a $10,000 income still because she's working in the business. The remaining allocation of the profit. So we don't have any profit left. So this is going to look different. So you have, let's start with how much we made. Made $6,000. Then we paid out a salary of $10,000. So we now have we have a loss of $4,000. So how are we going to split that? Well, the losses and the incomes are split the same way. Chase gets actually a bigger amount. So negative 4,000 times 70%. He has 2,800 that he has to cover. And then Chloe, of the negative 4,000, covers 30% of it. So she's going to cover 1,200 of the loss. So the total loss is $4,000. So the total division of the income is Chase has to pay 2,800. Chloe gets 8,800, so she actually ate into her salary by having to cover that loss. And then the total income was $6,000. And then on the last one, they lost $10,000. So we start here. Chase didn't get anything. Chloe still got her salary. Then we started with a loss of $10,000. Then we had to pay out $10,000 in salaries. So now we are at negative $20,000. And we're going to allocate it the same way we did this. Chase is going to get 20% of that, or not 20%, 70% of that loss. And Chloe's going to get 30% of that loss. So then total loss was 20,000. And then how it all shook out was Chase lost $14,000. Chloe lost $4,000, and the business overall lost 10. So it is interesting when you have that salaries line, which you have to pay the employee if that one partner is working in the business, how that plays out, what that looks like. It's important to go through this process. For exercise 3, we have the partnership Tasha and Bill shares profits and losses in a 50-50 ratio. The partners have capital balances of $45,000 each. Prepare a schedule showing how the bonus should be divided if Ashanti joins the partnership with a $60,000 investment. The partnership agreement will share profit and loss on a 1-to-3 ratio. So, the total capital of Tasha and Bill says each partner has capital balances of $45,000. So their capital balances together are $90,000. The investment by a new partner is $60,000. So then the total capital of the business is $150,000. Ashanti's capital credit, which is 1/3, 1-to-3 ratio, 1/3 of $150,000 is $50,000. So the total bonus that Tasha and Bill would be the difference between her capital credit and the investment by the new owner. So $10,000, which would be split between Tasha and Bill. But this number is the difference between these two numbers. What she paid in, or what her credit is worth, versus the investment. For exercise 4, we have Cheese Partners has decided to close the store. At the date of closing, Cheese Partners had the following account balances. A competitor agrees to buy the inventory and the store features for $20,000. Prepare the journal entries detailing the liquidation, assuming the partners Colette and Swarma are sharing profits on a 50-50 basis. So we have a competitor agrees to buy the inventory and store fixtures for $20,000. So inventory is $15,000, store fixtures are $10,000. So that's $25,000. He's selling them for $20,000, so they have a loss. That's the first thing to note. It doesn't give us a date, so we're just going to go with November. So they are going to receive cash of $20,000. Then I'm going to bounce down here for just a sec. And they are going to sell their inventory for $15,000 and their store fixtures for $10,000. So we've got a gap here. This is worth $35,000. $25,000. We only got $20,000. Well, that's just kind of the way the life goes sometimes. So we're going to have to take a loss on it, and we have to record it as a debit to a loss on a sale and for the amount, which we lost $5,000. Then it says that prepare the journal entries detailing liquidation and assume they share the profits on a 50-50. So we're going to assume that they share the loss. So we're going to assume they share that loss on a 50-50 basis as well. So it's going to come from Colette. I better put it up here, make sure I don't do this, don't lose squares. So half of it's going to come from Colette Capital and Swarma Capital, and they're both going to take a 50-50 split of that. So 2,500, 2,500, and that'll clean out the loss on sale of 5,000. Then we have to pay out the accounts payable. So the accounts payable, we're going to clean it out from cash. So 11/1/2020. We're going to pay this accounts payable off for $22,000. Oops. It's going to come out of cash. So we're wiping out everything. So we took, let's see. All right, let's just kind of break this down as I'm going through it so we can see where we're at. So we have cash, and let's just do a little T account right here. So we had, okay. We had a debit here of 20,000. So we're going to have, well, let's put our beginning balance. We had 6,000. And then we sold some stuff, so we had 20,000. Then we have 22,000 down here. So we're going to debit out or credit out that because we paid off of much bills. So our balance is going to be $4,000. So at this point, we have cleaned out the inventory, the store fixtures, the accounts payable. These three are gone, so I could actually go. There we go. That's what I could go and I could clean out that. I could. Oops. Could clean out. Other line, I made it. There we go. I could clean out the store fixtures, and I could clean out the accounts payable. All those accounts are gone. So now I just have to clean out capital and cash. So my cash, I'm down to, this balance has been adjusted up here because I went through, I made some more entries to it. So I have $4,000 in cash that I need to handle, and I have $9,000 in capital. Well, I only have $4,000, so that's how they're going to get it. That's all they have. That's all that's left to split. Doesn't matter that I can't pay out their full capital. It just they had to take the loss. So that balance of cash is going to be split 50-50. So it will go Colette capital $2,000 and Swarma capital $2,000, and it will be paid out in cash $4,000. So then we've just cleaned out that balance as well, and the capital accounts just kind of ended where they ended because we dissolved the business. Then our very last exercise is the partnership of Michelle, Amal, and Maureen has done well. The three partners have shared profits and losses in a 1-to-3 ratio, with capital balance of $60,000 each. Maureen wants to retire and withdraw. Prepare a schedule showing how the cost should be divided if Amal and Michelle decide to pay Maureen $70,000 for her retirement of her capital account, and the new agreement will share profit and losses 50-50. So they want to pay her $70,000. The retirement of Maureen's capital is $60,000. They each have $60,000 capital balances. So the reduction for bonus to Maureen is $10,000. So Amal and Michelle both lose 10,000. Well, they lose 5,000. They're going to split this by 50%. So they're going to lose $5,000 each because they want to pay her out that other $10,000. So the payment to Maureen was $70,000, but her capital balance was only $60,000. So they have to come up with that $10,000 somewhere. So they're going to take it actually out of each of their capitals. So they're going to reduce their capitals by $5,000 and $5,000 to come up with that $10,000.